Hello ladies and gentlemen, my name is Tshireletso Makwala. I'm a certified accountant from the University of Johannesburg, and today I'm going to talk about financial wellness in businesses. So the importance of accounting in businesses and the role of accounting in businesses basically. So there are two branches of accounting: managerial accounting and financial accounting visuals. So I understand that most people are self-employed in terms of their creating or have like their own businesses. So it's either you are self-employed or you have your own business. It doesn't matter. I'll discuss basically all entities and the importance of accounting in all entities. By the way, I'm a certified accountant who's currently doing his postgraduate diploma in the University of Johannesburg. I'll start explaining what accounting is. So, what is accounting? Accounting basically is record keeping of what's happening in your business, and that is necessary for every type of business because then that's where value is created. There are two branches of accounting, mainly managerial accounting and financial accounting. I'll start with the most important one. The first one is managerial accounting. So managerial accounting is most important because it is used in all businesses, because basically that's where you're gonna determine where the value is created. So value creation is the motto for managerial accounting, and for any type of business to thrive, it has their owners or shareholders or whoever has an interest in that business has to know managerial accounting. Managerial accounting is basically an accounting that emphasizes repetition and policy creation. I'll explain why that's necessary for business. So for a business to thrive, it has to work on two principles, mainly deliberation and repetition. Once every action that a business owner takes is deliberate, then the business will thrive. By deliberate, I mean there is no action that you take just because you think something should happen. It has to be based on factual evidence or experience. That's where managerial accounting takes place. This is where you start when you're starting a business. So when you start a business, firstly, a business, like any individual, it has to have goals, number one. So the business has to have goals. If the business doesn't have goals, then it won't have a direction to take, meaning it won't have purpose, it won't have a reason why it is established. So the first thing for any business to have is goals. Now the business that you are talking about in this case, I'm talking about profit-making businesses. So since profit-making businesses are on a profit-making scheme, that means that their goals should also be in line or in tune with that. So basically, how much profit you wanna make in a given year. That's the goal you have to have. So how much returns you wanna yield in a given year. Because if you establish a business, you are basically on an investor position. Even though you're a businessman, you are also an investor, because you're investing. It's either you're investing your time or you're investing your money or you're investing both. And obviously when you invest, you want to yield returns, because that's what a business is for. You invest to yield returns, and basically you want to know how much returns you want to yield. Therefore managerial accounting, that's what it's there for. So basically you're going to write your goals down, what you want from the business. And then so the quality of your plan will depend on two factors. It will depend basically on whether you're starting the business or whether your business has been in existence. When you're starting a business, your plan should include a lot of research, because you don't have experience for how many clients you can receive in a given amount of time. However, if it's already an ongoing business, you already have an idea of how many clients you receive on a given amount of time. Then you have to establish a plan to get to that goal, to see whether that goal is feasible or realistic. Because it is important that, like I said, for a business to thrive, every decision that you make must be deliberate. So you make that plan. I'll give you an example. So if, let's say, you're a personal trainer, you're gonna have most personal trainers have two schedules. They teach classes, and they are also personal trainers to other clients. So you're gonna have a diagram that lists from Monday to, I don't know, Sunday, depending on which days you work. Where do you work at which time? So when are your classes? When are your clients? And who are you seeing? You have to make that diagram so that you establish policies for yourself. So basically, on Monday I work this many hours on this many clients and I make this much. That's what I mean when I say it has to be written down. It has to be detailed, so that if, let's say, a client comes to you and says, hey, can I please join one of your personal trainer classes or your PT classes, you know exactly where to slot the client. Then secondly, you have to look at the type of client you have. So I'll use personal training as an example too. There are many categories that basically of fitness that you work with. There's weight loss programs, there's boxing, there's cardio, there's a lot. So for each client you have to have a profile basically of their progression and why those clients didn't reach their goals, so that you know next time, for when a client comes and says they want to maybe do cardio, you know the risks involved with clients that want to do cardio. Because in the end, you want clients to reach their goal, and that's basically what managerial accountants do. You want to create value. So that's where value is created. When you see exactly what the problem of the client is, and you fix it, or you give them what they want, that's where the value is created. Then the third type of thing. So the first thing is having goals. The second thing is having a plan for those goals. So how are you going to reach those goals? And it has to be detailed to that point. So Monday it has to be detailed day by day, week by week, month by month. It has to be detailed. That's what gonna set you apart from other trainers or other individuals, because you'll be paying more attention to what the client wants and what your business needs. Then after that is the third step, which is continuous improvement. So continuous improvement is also known as control. So basically, you're gonna go back and review whether the plan that you made it went exactly as planned. If it didn't go exactly as planned, it's either two things happened. It didn't go exactly as planned, meaning it wasn't favorable for the business, or it was more favorable for the business. So in both of those instances, although a plan not going as, if let's say you establish a plan and it doesn't go as you plan and you get more money as a result, that's still not okay, because that's not a business mindset. A business mindset says, when I have a plan, that plan must be followed to the T, and it has to produce this amount of result. Then if you produced more than what you expected, you have to go back to the drawing board and see why you produced more than you expected, and also note it down, so that you know, which means the plan that you made, it wasn't really realistic, meaning it was too pessimistic. So in business, you can be too pessimistic or too optimistic, and that's not okay. You have to be right in the middle. You have to be like, that's why I say every action has to be deliberate. It has to go towards a certain goal and yield a certain result. Because in the end, you have to think of a business like, if I can give basically a certain person who has the same skill set that I have, the same social skills that I have, this schematic of how the business should run, that person will make the same amount of money. And that's how employees are created in the business. So basically, that's how you employ people, and that's how you establish policies for employees, because basically they have to perform the same job over and over again. And in the end, if you want to establish maybe a big sized firm or a medium sized firm with employees in tech, that's what you have to have in mind, because they have to work a certain way and yield a certain result, because it is proven. You actually went through the process of actually selecting policies or creating policies that yield a certain result. Like I said, deliberation, I can't stress this enough. Deliberation and repetition, meaning consistency for business, is important. It's the most important thing. It's better to get 10 rand every day, but knowing that at least you are getting the 10 rand every day from doing this action a day, than getting 100 rand maybe today, 50 rand tomorrow, 200 the next day. You plan to get 100 rand on a daily basis. That's not sustainable for business, because that means that if you can put another person in your same shoes, they can tell you stories, maybe things like, today I made 50 rand, and they might not be able to explain why they made that amount. So consistency is important in business. So that's managerial accounting. So managerial accounting has three components. It has the goals phase. So you have your goals, you have your planning, and then you have continuous improvement, where you actually see whether your goals came to fruition. If they didn't, you're gonna do some adjustments to those goals based on reality, and then continue forward with your business in the way that you changed it. So the first branch of accounting has to be used by every type of business. It doesn't matter what type of business, from small firms to micro businesses. It has to be used by every business. If you can look at every business, and I'll take other businesses except personal training, things like McDonald's. McDonald's is the same everywhere. You see, Nike is the same everywhere. Certain stores, businesses that actually thrive, are thriving on one principle: deliberation and repetition. So that's what managerial accounting is for, and it has to be, if you are an owner, a shareholder. So as long as you have a controlling interest in a business, meaning you can control the decisions made in that business, then you have to have managerial accounting skills. The second branch of accounting is financial accounting. Now, financial accounting is actually done by the accountant. So that one is a professional job, that one. So that's where accountants prepare financial statements. And basically, the importance of that one is, if you want to take your business from a small business to a macro business, because all macro businesses have financial statements. However, if you're still comfortable with your business being small or medium sized, then it's not a necessity to do financial accounting, and I'll explain why. So financial accounting, it's an accounting, a branch of accounting that prepares statements in a certain way. So why is it done by huge firms? That's because of its principle. So financial accounting, it's done to attract users. So it's for primary users of financial statements. By primary users, I mean, so basically there are three primary users of financial statements. There is investors, there are bankers, and there are creditors. So for every macro business or big business that you know, they all prepare financial statements. That is because a lot of people have invested in that company, meaning there's a lot of funds that were put in that company. That's why if you wanna have a big business, you have to have financial statements, because there is no way you can get so much capital alone. So you need banks, you need other investors, you need a lot of investors. So that's why even big businesses go to the stock exchange or JSE. So that's basically what they are doing. When you buy shares on the stock exchange, or on the stock exchange, or using any broker, those shares basically are listed there, so that the public can fund the business. So so big businesses, macro businesses need massive funding in order to make that business run. So if you want to take your business from small or medium sized to big, then financial statements are a necessity. So what are financial statements? So financial statements basically paint a picture to investors and bankers and creditors of your, basically, the business's financial position, the business's performance, and basically how the business manages its cash flows. And this is important for investors. So basically they will see two things. These statements present two informations. So it will present the first information is firstly, how much assets your business have. So how much does your business have in terms of assets, building, equipment, all of those things, how much the business has. So that's the first thing. Then the second thing is stewardship of the business assets. So basically how management manages those assets. You can have businesses that have low assets but a high stewardship. Therefore, the business is thriving on small assets, because like management is of a high quality. But management of a high quality also, it's dependent on management that has high quality managerial accounting. So if your management accounting skills are on track, then your business can be funded by investors, even if your business doesn't have like many assets. So, and that's what investors mostly are looking for, because a business basically is not an idea, but it's basically what I told you in managerial accounting, that a business is basically a policy that works. So if anyone can use it, it'll work. So investors will want to buy basically a share of so basically a piece of that pie, of that policy, because it works, it generates money. It's something that's, so basically it's something that's alive, because it's something that can be used by anyone. It's not dependent on you, it's not dependent on anyone. It's only there like as a policy. So it's only dependent on the skills and skills and competency of anyone who's doing it. So that's what investors will be looking for, and from the statement they'll be able to see whether or not to invest on the business or not. So what I can say is financial statements are used by investors, bankers and creditors. So it's not used by maybe you, if maybe you are owning your own business, or you are a shareholder in a business, or a member in a cooperative maybe. Those financial statements will not be used by you. That's why you don't prepare them for you. So if, let's say, someone comes to you and says, hey, let's prepare financial statements, just know that the reason why you prepare financial statements is to get funding. So funding from those users, investors, bankers or lenders. That's the main reason for financial statements, funding. Then managerial accounting is for creation of value, maintaining value, and also improving value. Thank you.